In the year 2000, a financial analyst in Boston sat down with a stack of Bernie Madoff's investment returns and started running the numbers. 4 hours later, he knew. Not suspected, not theorized. It was mathematical certainty that Bernard Madoff was running the largest financial fraud in the history of Wall Street. He documented everything. He built a case. He walked it directly into the offices of the Securities and Exchange Commission, the single most powerful financial regulator in the United States, and handed it to them. They thanked him and did nothing. He came back in 2001. They did nothing. He came back in 2005 with a 17-page memo titled, "The World's Largest Hedge Fund is a Fraud." It listed 30 specific red flags. They did nothing. He came back in 2007. Nothing. He came back in 2008. Nothing. Bernard Madoff was not caught by regulators. He was not exposed by investigators. He confessed voluntarily to his own sons in December 2008 because the financial crisis had triggered so many investor withdrawals that he could no longer keep the lie running. His sons turned him in. The Securities and Exchange Commission had nothing to do with it. By that point, $64.8 billion had been stolen. Thousands of investors, retirees, charities, families, and pension funds had been wiped out. And the man who had handed the Securities and Exchange Commission a roadmap to Madoff nearly a decade earlier was sitting at home watching it all collapse, knowing that every single dollar of that destruction could have been prevented. His name is Harry Markopolos. What happened to him is not just a story about one fraudster. It is a story about a regulatory system so broken, so captured by prestige and reputation, that it could look directly at proof of the biggest Ponzi scheme in history and choose not to see it. If this is your first time on this channel, we go inside the boardrooms and back offices where billion-dollar decisions are made and unmade. Subscribe now so you never miss a case, because what is coming in this series will leave you questioning everything you thought you knew about who is actually watching the watchers. Harry Markopolos was not a crusader by nature. He was a numbers man, a forensic financial analyst working at a Boston investment firm called Rampart Investment Management in the late 1990s. He was the kind of person who found genuine pleasure in the architecture of financial mathematics, who saw numbers the way a musician hears chords, as things that were either in harmony or deeply wrong. In 1999, Rampart began losing clients to a competing investment manager whose returns were, by any measure, extraordinary. The manager's name was Bernie Madoff. Madoff was already a Wall Street legend, a former chairman of NASDAQ, one of the largest market makers on the New York Stock Exchange, a man whose name alone opened doors that took other people decades to reach. His wealth management operation was delivering consistent returns of 1% to 2% per month, month after month, through bull markets and bear markets, through crashes and corrections, with almost no losing periods. His clients believed they had found something rare, a genius who had cracked the market. Markopolos' bosses at Rampart asked him to do something simple: study Madoff's strategy and replicate it, build a competing product. They were not asking him to investigate Madoff. They were not suspicious of him. They wanted to copy him because the returns he was delivering were so consistent, so reliable, so apparently risk-free that Rampart was losing clients who simply wanted in on whatever Madoff was doing. It should have been a routine assignment. It took Markopolos 4 hours to realize it was impossible, not difficult, impossible. The strategy Madoff claimed to be using, an options-based approach called split strike conversion, could not mathematically produce the returns he was reporting. Markopolos ran the numbers every way he could find. The returns Madoff claimed did not just outperform the market, they defied it. A nearly perfect upward line at a 45-degree angle on a returns chart. No significant drawdowns, Only 7 losing months across more than 14 years of trading. That line, Markopoulos would later say, does not exist in finance. It only exists in geometry classes. There were only 2 explanations. Either Madoff was front-running, illegally using his broker-dealer knowledge of pending orders to trade ahead of his clients, or he was running a Ponzi scheme. Markopoulos believed it was the Ponzi. His reasoning was simple. A Ponzi scheme requires a constant flow of new money to pay existing investors, and Madoff was voraciously, almost desperately, pulling in new investment capital. That appetite did not fit a man who was merely cheating on the margins. It fit a man who needed every new dollar just to keep the previous dollar's promise. On March 1st, 2000, Markopoulos walked his findings into the SEC's Boston regional office and submitted his first formal complaint. He explained the mathematics, and he explained why the strategy was impossible. He gave them names, numbers, and a clear analytical framework for why Madoff's returns could not be real. The SE reviewed his submission and concluded there was insufficient evidence to pursue an investigation. Markopoulos went back to his desk and kept working. He built a team, 3 colleagues who shared his conviction that something catastrophic was being ignored. They called themselves with grim humor the Madoff Task Force. They had no authority, no budget, no institutional backing. Just the evidence and the belief that eventually someone in power would have to listen. In 2001, 2 separate financial journalists, Michael Ockrent at Marhedge and Aaron Arvidland at Barron's, published articles questioning Madoff's returns. The Barron's piece ran under the headline, "Don't Ask, Don't Tell. Bernie Madoff is so secretive, he even asks investors to keep mum." The articles raised serious questions. They were read by sophisticated Wall Street professionals. They generated 0 action from the SEC and did not slow Madoff's fundraising by a single dollar. Markopoulos submitted another complaint to the SEC that same year. Nothing. By 2005, Markopoulos had enough evidence to fill a courtroom. He compiled it into a 17-page document, meticulous, specific, devastating, and submitted it to the SEC's New York office. The memo listed 30 separate red flags. It explained, step by step, exactly why Madoff's reported trading activity was mathematically impossible, given the actual volume of options contracts available in the market at the time. If Madoff was trading the way he claimed, he would have needed to control 100% of the entire Chicago Board Options Exchange's open interest on certain contracts. The market simply did not have enough volume to support what he was reporting. The SEC assigned the memo to a branch head in their New York enforcement division named Megan Chung. She reviewed it. She met with Markopoulos. She concluded that his evidence was insufficient to open a formal investigation. In her later deposition, one of her staff members revealed the standard they were applying. The only way Markopoulos would qualify as a credible whistleblower, she said, was if he arrived with a tape recording of Bernie Madoff personally admitting he was running a Ponzi scheme. Markopoulos said years later, "Obviously, if I had that tape, I would not have needed the SEC." That same year, Markopoulos approached the Wall Street Journal with his evidence. The editors reviewed it and decided not to pursue the story. Bernie Madoff was too respected, too established, too connected. The idea that he was a fraud was simply too difficult to believe for the institutions whose job it was to ask exactly that question. Markopoulos submitted again in 2007. The Securities and Exchange Commission opened an inquiry and closed it without finding fraud. He submitted again in 2008. The financial crisis was already beginning to crack Madoff's operation from the outside, and it didn't matter anymore. In December 2008, the markets collapsed far enough that Madoff's investors began demanding withdrawals he could not cover. The money was not there. It had never been there. On December 10th, Madoff told his sons Mark and Andrew that the entire wealth management operation was one big lie. His sons called their lawyer. The lawyer called the FBI. The next morning, federal agents arrested Bernie Madoff in his penthouse apartment on Manhattan's Upper East Side. The fraud totaled $64.8 billion across 4,800 client accounts. At least $35 billion of that figure, Markopoulos estimated, was money that had never existed at all. Fictional profits that Madoff had simply typed into account statements for decades. Real people had paid real taxes on fictional gains. Retirees had built retirement plans around numbers that were invented. Charities had spent decades distributing what they believed were investment returns from a Ponzi scheme. René-Thierry Magon de la Ville-Houchet, the European fund manager who had first introduced Markopoulos' firm to Madoff years earlier, lost $1.4 billion of client money in the collapse. He was found dead in his Manhattan office on Christmas Eve 2008, his wrists slashed, an apparent suicide. On March 12, 2009, Madoff pleaded guilty to 11 federal crimes. He was sentenced to 150 years in prison. He died there in April 2021 at the age of 82. If you have been watching this story unfold and finding yourself asking the same question, how does this keep happening? Please subscribe, because that question is exactly what this channel exists to answer. Every week, we open another file. Harry Markopoulos testified before Congress in February 2009. He did not hold back. He described the SEC, the Securities and Exchange Commission, as an agency that had failed completely in its core function, not due to a single mistake, but because of a systemic culture that treated the reputation of powerful financial figures as more important than the evidence placed directly in front of them. He testified that he had feared for his personal safety during the years he was investigating Madoff, that he had worried about what Madoff's connections might mean for someone working to expose him. I was worried, he said, that I'd be the one who ended up in trouble. The deepest lesson of the Markopoulos story is not about Bernie Madoff. Madoff was a criminal, and criminals exist in every era. The lesson is about the system that was built to catch him, and it chose 9 years in a row to look the other way. Reputation is not evidence. Prestige is not proof. And an institution whose job is to ask hard questions is useless if it has decided in advance who it is and is not willing to ask those questions of. Every dollar that Madoff stole after March 1st, 2,000 was stolen in the presence of a regulator who had been told exactly what was happening. That is the number that should sit with you long after this video ends. Thank you for watching Executive Files Uncut. The paper trail never lies. The people reading it sometimes do.